My name's Ralph Lehman. I am president of the East Tennessee Society. I would like to welcome everyone who's joined us. We are about to have a very interesting talk given by John Eubanks of Park Sutton Advisors. And I'll go ahead and brag a little bit on John. He's a fellow Bulldog, although a lot of time elapsed in between the two of us. We're at the University of Georgia. Before John speaks and his people are filtering in, just a couple of announcements. And one in general is this is the first time that we've done something like this. I'd like to give a shout out to John Lowley, who's done quite a bit of work and gotten himself up to speed on this. And this process is going far more smoothly because of the work that he's put into it. And so very grateful for John and the work that he's done. Grateful also for our programming group in getting this meeting set up. When it got set up, everything looked much differently than it does now. And perhaps that has caused John to adjust his talk a little bit. So I'm curious to hear what that will be like. Just a couple of things society-wise to throw your way. One, we are looking for ways that we can remain connected in spite of this. I'm hoping that the state of Tennessee is going to allow a little more interaction to where we can host meetings again. Typically for us at Cherokee Country Club and then Chattanooga, there's a couple of places. If that's the case, then we will hopefully attempt to do something in May or early June before the summer season starts up. But we are going to send a survey afterwards. And one of the things we're curious is, would this type format meeting be something that you would be interested in going forward? Not to replace our personal meetings where it's always good to network and to see folks, but in conjunction with it, it might be a way that we could expand the number of meetings that we have and do it in a way that would be convenient around people's schedules. So there will be a survey that we're going to make available. We'd love to get some input. And then secondly, as we're winding down on a year, we will be seeing a transition in our leadership team that comes about every year. I am filling almost the second year of my term as president. I will be stepping aside. We are going to be having some new leaders stepping in, and we are looking for some people who would like to get involved in the society, whether it be ultimately in an officer role, but then we've got several committees that we would be well served if some of you considered serving on them. There are things that we could be doing. There's things that we might be doing a little bit better, that if we could engage our group more, then we can engage our members far more and provide some services. And then this is putting this out there. I think our area, given the nature of our constituent members and their firms, is doing okay going through this very trying time. That is not the case across the board. And we do have a number of members who are struggling. I've seen a couple times where people are looking for jobs, given the changes going on. We want to be mindful of that. And I would like to extend to everyone that if you do find yourself in a position where you're looking for a job, please reach out to the society, that we can be a resource. We can put you in touch with other societies as well. We want to be here and help. The CFA Institute wants to be a valuable resource as well, and they are working on things. But just with the exam being at least delayed or put off a year, there's been quite a bit of disruption. And therefore, I'm very grateful that John agreed to continue to do this talk, albeit in much different circumstances. It's nice to have some continuity, and that's hopefully something that we'll be able to continue in spite of all the disruptions that are going on through this year. So that in a nutshell are my comments. Again, thank you for everyone who's joining. As I close this, this is Ralph Lehman, the president. I'm just now about to introduce our speaker, John Eubanks, and I will go ahead and do that. That John is with Park Sutton Advisors, and they do valuation and succession planning in the asset and wealth management industry. This is an area that I have seen, given that I'm getting a little bit older, a lot of change that went on from the 80s into the 90s, and now up until the present age, because the nature of our business has changed quite a bit and will continue to do so with technology. And then just how people are approaching work, the fact that we're doing things like this. So John has had an interesting career already leading up to this. I'm hoping he'll touch a little bit on how he ended up finding himself working in this area, because I think that in and of itself will be an interesting story. I brought this up in our discussion, but just to say it again, John is a fellow Bulldog. I don't get to spend a lot of time with many Georgia Bulldogs here, so I'm especially glad to introduce a fellow Bulldog. And with John, with that, please have the floor, and thank you very much.
Thank you, Ralph. I appreciate the introduction and appreciate everybody on the call taking some time for us today. I know that the environment is a little unusual and a little difficult, and I know that for those of you who deal with wealth management or asset management clients on a day-to-day basis, probably making sure that they're comfortable and sticking to a long-term plan takes a lot of time in this sort of environment. So thank you again. And so as Ralph mentioned, I am an investment banker and merger and acquisition advisor focused exclusively on the wealth and asset management industry. So we work with owners and management teams of RIAs, broker-dealers, trust companies, and other related businesses, really helping them execute on mergers with or sales to strategic partners, helping grow through acquisitions, as well as implementing internal transfers of ownership for firms that want to pass that equity ownership to second generations. So a big part of that is valuations and understanding what firms are worth and how to transfer that value, whether it be externally or internally. So my background in this industry is a little bit unique because in my 15 years in financial services, I've spent about 2/3 actually in the wealth and asset management industry and 1/3 in M&A and investment banking for the industry. So I've been in institutional consulting. I was at Merrill Lynch at one point working for an institutional consulting group. I've been in private wealth management and was a partner in an RIA that had actually been through a transaction with one of the national aggregators out there that is acquiring wealth management firms. So I have a little bit of a different perspective, both having gone through a transaction myself and being part of that succession, as well as having advised a number of firms through those transactions as well. So Park Sutton is based in New York, but I actually live in Macon, Georgia, which is where I'm from originally, and cover the Southeast for us. So prior to the widespread shutdowns across the country, I was spending about 2 weeks a month traveling throughout the Southeast. This event was originally supposed to be in Chattanooga today and Knoxville tomorrow, I think. But now we've been doing a lot of these meetings by Zoom and WebEx, which is interesting to get used to. But again, appreciate everybody joining us today. And so to really understand where we are today in the current M&A environment and in terms of valuations for wealth management firms and asset management firms, it helps to understand where valuations have been in the past. And as Ralph mentioned, there are certainly some changes over the last couple of months that we can address, more specifically as far as how the current environment has impacted transactions or impacted valuations. So to start with, I'll go ahead and touch on that subject because I think it's important in the context of the bigger picture of the M&A landscape. So at the end of last year, we were seeing valuations for wealth and asset management firms that were really at all-time highs. Some people might even say were probably unsustainable to begin with. And so a lot of independent wealth management firms were selling for 7 to 10 times EBITDA. So, a firm with 500 million in assets and 30-40% EBITDA margins could be worth a lot of money compared to historical valuations. And so it was getting to the point that we were seeing, again, 7 to 10 times EBITDA on a lot of these independent wealth and asset management firms. And then in addition to that, deal terms themselves and transactions were getting pretty favorable to sellers. So we were seeing some deals occurring where 80%, sometimes 90% of the purchase price was being paid at closing, which historically that number has been closer to 50%. So again, just there was a lot of activity. Last year saw the highest number of transactions for RIAs than any other year in history. And so very active market, a lot of buyers, a lot of sellers, and we'll touch on some of those things shortly. But as far as what's happened over the last 3 months to sort of set the stage for all this and what has happened with the recent volatility is that the deals that were ongoing to begin with that started, middle of last year, late last year, that were getting toward a closing, the first quarter of this year, pretty much stayed on track, and we didn't see a lot of changes to valuations, to deal terms. Even the ones that were signing definitive purchase agreements within the last few weeks really kept the same original terms that were presented by buyers in the original letters of intent that may have been originally signed in December, January. So with if you divide it into sort of 3 categories, those deals were toward the end, really haven't seen any changes to deal terms. That activity continued. It's not like things just stopped. And then second category would be those deals that, were sort of earlier stages, maybe beginning stages of sellers starting to talk to buyers and really just starting to sort of go out to market. And because those are early, mid-stage, it's hard to say how they're going to end up. But even there, we haven't seen this big change in buyer interest so far. I mean, buyers have stayed in the market. Well-capitalized buyers have said, we're going to continue making acquisitions of wealth management firms. And so we haven't seen, a decline in interest from buyers. We haven't really seen a decline in interest from sellers. If anything, there are probably a lot of people who are in their late 50s, early 60s that are considering a transaction for succession purposes or for retirement. That really maybe taking a step back and saying, we don't want to live through another 08, 09, and let's go ahead and really work to get a transaction in place, a succession plan in place now, so that they don't have to deal with that if things do actually get worse from this point. And then the last category would be those people that are just now starting out, that people that were considering doing a transaction, considering selling their firm, maybe considering making their first acquisition as a means to grow their firm, and where that group is. And even with those, so we just signed a new client actually at the beginning of last week that is looking to sell their firm as part of a longer term succession for the 3 founders. And their mentality, and a lot of those that we talk with, is that at some point we're going to have to do this anyway, and just because we've had a decline in asset levels and uncertainty going forward, we shouldn't just put off the planning that needs to be done anyway. And so that just kind of the backdrop into where we are today is that the biggest thing that we think is going to change is probably going to be the actual deal structure and transaction terms. themselves rather than valuations. So probably what you'll see is going back to the norm in the past of, 50 to 60% cash or cash in stock paid at close, with the remaining 40 to 50% paid based on retention and earnouts, so that acquirers can spread that risk out a little bit better than they were probably doing by paying 80, 90% at close. So to really get into where we are today, it helps to know where we've been up until now. And so really, even today, again, since we really haven't seen valuations declining yet, and it's hard to say what will happen over the next 6-12 months, haven't seen valuations declining yet. And so we're really still at a level that we were prior to the 2007, 2009 recession. Where, revenue multiples could be, 3, sometimes as high as 4 times revenue for good quality wealth and asset management firms. Again, EBITDA ranges 7 to 10 times. And so after that 08, 09 recessionary period and bear market, you did have a slowdown in M&A activity, and you got back down to valuations that were really got as low as 1.5 and 2 times revenue, with average EBITDA multiples falling 6, 7, maybe 8 times on the top end. And then through the 2010, really through the end of 2019, as asset levels grew again, as outside capital entered the market to acquire wealth and asset management firms, you saw those valuations start to creep up again to where we were at the end of the year, and really close to where we still are today. So a big driver of activity has been the entrance of private equity and outside capital into the wealth and asset management industry. So if you think about what private equity firms really look for when they look to acquire a new business or enter a new industry, there are a number of factors they look for. So I'm going to try to see if we can make this poll here work. I had some questions to show. So you should be seeing a question pop up here on your screen shortly about what it is that private equity groups look for. So I'm curious to see what thoughts are about private equity groups and what their really most important points are when they seek to acquire a new firm. So I'll give you all a couple minutes to look at it and provide your thoughts. It looks like we've got a couple answers coming in here, and it's interesting seeing sort of the spread between stable customer base, recurring revenue, fragmented industries, which is interesting because this really was sort of a trick question to begin with, because these are really these criteria here are really what all private equity firms seek when they're looking to make investments in an industry or in a new business. First, they want a stable customer base. They always want strong free cash flow so that they can use that cash flow to invest and grow the business once they take over. Recurring revenue is important. Barriers to entry is important. Fragmented industries is also important. So if you think about what is being described here, this describes really perfectly the asset and wealth management industry, because you have a stable customer base that they're not only stable for the most part, but they're sticky. Wealth management firms and asset management firms tend to have low client turnover in general. They have strong free cash flow. They're very profitable. They have recurring revenue. There are barriers to entry because of SEC registration requirements and other related regulatory issues. And it's a fragmented industry. And so it's really, when you think about all this, it's really surprising that that private equity groups did not enter the wealth management and asset management industry earlier than they did and want to have ownership in these firms in previous years because it really meets all of the criteria that private equity firms typically look for. So basically, throughout this time, a big driver of activity, driver of valuations has been that external capital. So on a related note, in terms of where we are today and where we were at the end of 2007, here's another interesting fact that I found. See if we can launch a second poll here. I had another question related to private equity, and this is interesting. Some of you may have seen this, but here comes the second question for you in terms of the amount of actual cash that private equity groups have available to deploy at the end of 2019. Because it's also even more interesting when you compare it to where we were in 2007 and 2008. So a couple of answers coming in at 1.4 trillion and 750 billion. 3.2 trillion. Congratulations to those of you who said 1.4 trillion, because that is the answer. At the end of the year, private equity groups had $1.4 trillion in cash to deploy. At the end of 2007, private equity groups had about 500 billion in cash to deploy. And so you're, 3 times basically the end of last year what was available at the end of 2007 going into the last downturn. That's a big number, and it particularly makes a difference when we're talking about an industry that private equity is particularly interested in. And so what you've had really is influx of capital, interest in the industry, aging owners who have decided to go through transactions. All these things have really built up this current environment that we're in today. And the interesting thing too about that is that I think the time frame that the private equity groups have today to deploy that capital is about 2.5 years before the capital calls are over and investors get their money back. And in 2007, it was 4 years. And so not only do you have 3 times the amount of capital, but you also have a shorter period of time in which that capital has to be deployed before they lose the assets and they go back to investors to begin with. So a lot of dynamics that really should continue to push the transaction activity forward, and a lot of underlying structural changes taking place that we don't really see changing, even with the decline in assets and decline in revenue that could occur with some of these firms. So when you think about structural changes facing the industry, one of the interesting things here, this is a chart of the number of listed companies in the U.S., publicly traded companies from the 70s through 2018. And so this is sort of representative of what's happening in general in public and private capital markets. The Wilshire 5000 that was launched in 1974 was obviously called the Wilshire 5000 because it had 5,000 stocks in it. Today, the Wilshire 5000 has about 3,400 to 3,500 stocks in it. So really what this means is just that companies are staying private longer because they don't need to go public. They have more financing options, and private equity is a big part of this whole dynamic. So ironically, the firms that, when PE firms begin looking for the latest industry to invest in coming out of the last recession, that would provide recurring revenue, barriers to entry, high margins, and all the other things we talked about, they really had to look no further than the wealth and asset management industry itself, which is the industry most tied to the stock market for wealth and asset management firms. And so it's all, there are a lot of dynamics at play here in general in public and private capital markets, and it just so happens that the wealth and asset management industry is one of the industries that's being affected more so than others. And so one thing here that sort of illustrates that point is the increase in RIAs versus the decrease in broker-dealers. And so what you've had over the last, really longer than this, I mean, this is just showing 14 or 15 through 2018 and 19. And what you really had is a longer period of this occurring, but you've had this huge push from traditional transaction-based, commission-based wealth and asset management businesses into fee-based wealth and asset management companies, as evidenced by, this chart here that shows an increase in RIAs at about the same pace of the decrease in broker-dealers that exist. And as that advice has really transitioned from transactional to fee-based, it's really been as a result of really consumer demand and what investors have been looking for. So at the same time, during this transition, you have a population segment of age 65 and older that's larger than it ever has been in the past, and will continue to grow as the baby boom generation continues to retire and continues to seek options for transitioning business ownership for their own retirement. And so then, based on the fact that you have a changing consumer demand for how advice is delivered, and you have this population segment that needs wealth and asset management advice at a greater rate than at any time in history, it's really sort of this perfect storm for M&A activity within the industry, because as wealth and asset management firms grow through helping those people that are at retirement age with their investments and with their retirement planning, the industry's experienced changes, the industry's experienced growth, and those are big factors that have come into play. So if you think about the differences between wealth and asset management, these terms mean different things to different people. But when we talk about wealth managers versus asset managers, typically the wealth managers are those that are providing more holistic offering around investment management. So they're providing, whether it be tax planning, estate planning, risk management, retirement planning, or other general financial planning services around investment management. Those are really what we consider the wealth management firms. Asset managers are just the ones that we consider to be traditional single fleet managers. So, they may have multiple strategies within a firm, but typically offering large cap, small cap, mid cap, sometimes international, they may be fixed income, maybe alternative managers. But in this environment, it's really been the high net worth businesses that have changed the M&A environment, because those are the ones that are catering to this segment of the population we discussed right here. So it's the wealth managers that are providing retirement planning that have really become more favored in these transactions, and are bringing the highest valuations because of that. At the same time, asset managers have been facing fee pressure with the changes under the Obama administration, with the fiduciary requirements and regulatory requirements in the wealth and asset management industry. You had a lot of firms out there that really were seeking to limit the number of managers available on their platforms. And so we're used to have thousands of fund choices and thousands of SMA managers on these distribution platforms at Merrill Lynch, Morgan Stanley, UBS, and all the regional broker-dealers as well. Now you have those firms seeking to limit the number of investment advisors that are available to their clients to invest in, because it's a huge headache to do the due diligence and all of the regulatory requirements that come along with that on managers to add them to their platforms. And so at the same time, while wealth managers have been growing in popularity and have been experiencing higher valuations, asset managers have been facing this fee pressure and platform pressure that they didn't in the past. And so they've also been going through transactions for different reasons, which is really more related to scale and maintaining margins and other related issues that they face in the current environment. So if you look at what's occurring on top of asset managers seeking scale and needing distribution, and high net worth managers being in strong demand because of the service they're providing to high net worth population, there's some recent deals that have really been shaping where the industry's headed, and we think these are all very telling, because some of the largest financial services firms out there in the past who kind of turned a blind eye to the growth of the independent wealth management space are now recognizing the amount of assets that are controlled by the independent firms, and are recognizing the opportunity that exists there to have ownership in those firms, as again, population requires it. And so what you've had is the Goldman Sachs that acquired United Capital, Schwab acquiring TD Ameritrade, Morgan Stanley recently announcing the acquisition of E-Trade. And all of these are really a push by these larger firms to go direct to the end client and control more of the wealth and asset management activity that's occurring. And so you had, number one, the private equity groups. Number two, you have these large strategic acquirers who are pushing to get in the industry for obvious reasons that we've talked about. And so that's how you've gotten to the point that we have today. And I won't spend a lot of time on this particular point, because we talked about this at the very beginning with wealth managers and the valuation ranges we're seeing. But those things have been the drivers of what have gotten us to this point. And so when you think about private equity, strategic buyers, the growth of the industry, changing consumer preferences, aging advisor population who need to retire at some point, it really the underlying fundamental structure, the fundamental reasons that are there for firms to consider a transaction to begin with aren't going away anytime soon. And in fact, an environment like this we could very well see it be a driver of activity, because again, people aren't going to want to live through another downturn if that is what owners are expecting, owners of these firms. So it could be something that we see actually create additional activity going forward. Again, don't know how valuations will be impacted in these open market transactions, but we do know that probably deal terms themselves with the structure will go back to less paid in cash at close, with more of it tied to earnouts. And if you think about, pulling all this together in terms of where valuations are the highest and the lowest in terms of just the transactions that are occurring, on the higher end of valuations, you have the traditional, the high net worth wealth managers that are, again, providing the holistic wealth planning service. They typically have a sticky client base, higher margins. And so those have been getting the largest valuations in sales recently. On the lower end, you have traditional asset managers. Right now, single sleeve strategies like the large cap value, large cap growth, large cap blend. Some of those firms are having a harder time, transacting to begin with because of a shift. There's the other shift that we didn't discuss is more of a move toward passive management over the years. And so you have a lot of the traditional single strategy managers that are on the lower end of valuations, although that's not always been the case. Years ago, asset managers were trading at higher multiples than high net worth wealth managers. So those things tend to change as the underlying structure of the independent wealth management industry changes. So, you know, things can easily flip again in the future. And so within the asset management space, though, you do have some firms that are really still pulling decent valuations and transactions, particularly niche managers and small cap, mid cap, mainstream alternatives, and some niche alternative managers also, because, you know, there also has been a big push to provide more options and more investment strategies to the high net worth and ultra high net worth clients. And so alternatives and some of these other different strategies have been growing pretty tremendously over the last few years. So valuations and some of those are close to what they are in the wealth management industry still today. So if you think about, again, who these people are that we've talked about so far, who the acquirers are, you've got private equity, you have strategic buyers, and then the third source of capital is just traditional debt. The interesting thing about the environment today, and when I say today, I mean even still with the last few months of volatility, is that loans are readily available to wealth management firms and asset management firms from traditional lenders. Banks have entered the wealth management space as a lender in the last few years. We've seen more and more banks offering specialized loan products for wealth management firms to use for acquisitions or to use for younger partners to buy out retiring partners. And so that's another dynamic here, is just the amount of debt that has been available to wealth management firms that was not in the past. And then you have the strategic acquirers. So these are your large national RIAs. They could be, for the asset management industry, the large fund companies that are out there, the multifamily funds, and then financial sponsors. You've got private equity, family offices, and the interesting piece, in addition to private equity, is the entrance into the market of family offices and what is referred to as permanent capital versus private equity. The main difference there, private equity groups typically have an exit period where they're trying to, once they acquire a firm, exit their position within 3 to 7 years. These permanent capital providers really want to take sometimes even a minority equity position in wealth and asset management firms. The reason for that is that, of course, with, you know, up until the end of the year, you had the stock market continuing on all-time highs. You had interest rates, you know, still near all-time lows. And so there was a big push for family offices and ultra high net worth investors to find ways to get higher yield current income on their investment. And so as a lot of them looked at, you know, where to place money, private capital markets have always made a lot of sense, you know, but then you look at the wealth and asset management industry, recurring revenue, high margins. A lot of what these permanent capital providers want is simply current income on their investment in perpetuity. So if you think about a family office that's got, you know, a few $100 million in assets that they're trying to deploy, it makes a lot of sense for some of those to consider acquiring a minority position in a wealth management firm. That's recurring revenue. It's a great dividend essentially to them in an environment where it's hard to find that kind of income elsewhere. So if you look at just the breakdown of who the players are among these different groups, among the strategic acquirers, you have more of the firms that have taken an aggregator approach. So if any of you are familiar with, you know, Focus Financial Partners, for example, or, you know, Hightower, some of these really are more focused on really pulling these independent firms together and providing them centralized resources and scale, but they can maintain their own brand. They can, you know, maintain their own autonomy in a lot of cases. And then you have the strategic acquirers that are really more focused on creating one large independent firm by acquiring these smaller firms and pulling them all together under one brand and centralizing that sort of overall marketing message and brand. across the entire footprint of firms that they own. And that's really the big difference between just the aggregators or roll-up firms and those strategic acquirers, is really in how they approach ownership and the brand going forward. And then in the financial buyer space, you've got traditional private equity groups, and there's some that are very active in the wealth and asset management industry, and there's some private equity groups that have never owned wealth and asset management firms as well, that are just now looking to get into the market. Some of the more permanent capital sources, which are those that are just looking to take a stake and earn a return on that capital, are Temperance Partners, Kudu, Immigrant is another one, which was previously Fiduciary Network. And then in addition to those, formal permanent capital sources, there are also a multitude of family offices that are looking to do the same thing with their own money within that family office. And so if you look at the reasons that firms are considering transactions, so we've talked about really the demand side of this equation, who the buyers are, why they're interested in buying, the changes in the landscape that are driving them to want to make acquisitions of independent firms. So now if you flip that and you think about sellers and why people would consider selling firms. So this is, talking about buyers. Obviously, they want to grow. They want scale. They want to increase profitability. They want to access talent. We went through a period in the wealth management industry, as I'm sure many of you know, where it was very difficult to find good young advisors because a lot of people stopped coming into the financial services industry for a period of years, and that is now thankfully switched back, and there's now more pool of quality employees. But for a while, access to talent became extremely important. So then you flip that equation on the sellers, and if you think about the path that someone has to go through as a founder, partner of an independent wealth management firm, at some point they have to start thinking about their own transition out of that firm. And so it may not, in some cases, necessarily even be about getting the most money. I mean, some people may be perfectly fine for retirement themselves without selling their firm, but there are other drivers that have to be taken into consideration. So first, for an external transaction, the reason sellers might consider that is if the second generation in place really, and this speaks to the point that Ralph made at the beginning of the call, talking about the attorneys, law firms, and CPAs. For those of you that were on the call at the beginning, just the discussion about how, some second generation wealth managers may not want to go out and bring in business. They may be content taking care of clients and perfectly capable of doing that and being great wealth and asset managers. But, if they can't grow the firm and can't grow assets, as anybody in the industry knows, that if a firm is not growing assets, they're essentially declining, because ultimately that client base is going to age and retire and start drawing down assets. And so if you as a firm are not replacing those assets, you're declining. So an external transaction may be considered simply because second generation is not interested in having to grow the business. Maybe that second generation is not there at all, and that there needs to be a transaction so that there is a solution for the firm's current clients once the owner retires. And then internally, again, second generation may be willing and capable capable of managing clients and even growing the firm. But then the next question comes, can they actually afford to buy the firm? As we talked about in the beginning, the valuations of wealth and asset management firms have been pretty significant in recent years. So if you take an average firm, let's say that somebody has $1 billion in assets under management, they may be generating $7 to $8 million a year in revenue, and could easily be generating $2 to $3 million in EBITDA on that number. So, you take those numbers and you say a firm like that with $1 billion in assets and $3 million in EBITDA, it's going to be worth $21 million on the low end, and then probably as high as $30 million on the high end. And so when you think about an owner, founder, creating a firm, building it to an asset base of $500 million in assets, $1 billion in assets under management, and then you have a group of 30 and 40-year-old second generation partners who are now asked to purchase the firm for $30 million, that's not always an easy transition to accomplish. And so that's one of the things that comes into play and has to be considered. And then the other is just reasons for transactions, maybe liquidity to grow. Somebody may want to grow their firm, and rather than taking on debt, they may sell a stake of the firm and sell an equity piece for capital, or they may want to simply take some chips off the table. If you're an owner of a wealth management firm and your wealth is concentrated in that firm, and there may be the desire to take some chips off the table and reduce that concentration risk. And so a lot of factors here for sellers as well. So while there are drivers, creating activity on the side of the buyers, there are a lot of reasons sellers are considering a sale or transaction. And so the two together have created the relationship or the M&A environment that we're in. The other thing when sellers are thinking about transaction, thinking about selling a firm or raising capital, there are very different components to address between a founder or current partners and the second generation partners. Founders are going to consider the financial aspects of a deal. What does it mean to them to keep working versus retiring? What does the transaction structure look like? How much risk is there to them in selling the firm? Who's the buyer? Is the buyer reputable? There are a lot of things that come into play that founders have to think about specifically. And then there are also certain things that come into play that the next generation has to consider and be involved in early on in these discussions for it to work well, which is just their willingness to go along with the transaction. And the reality of what it takes to grow a firm and to grow the assets of a firm. A lot of second generation partners, founders, or a lot of second generation partners may assume that founders are going to transition ownership to them. And then, when a $30 million price tag, for example, is placed in front of them, reality can sort of set in and they start thinking, okay, I've got to take a lot of risk myself to take on the debt to acquire this firm. Or I can do what I enjoy doing, which is taking care of clients and managing portfolios or providing the wealth planning services. So there are a lot of things that are sort of at odds between founders and next generation, but then there are things that are important to both, which is what you see in the middle here, that are going to be important for whether you're a founder or next generation. And the point of this slide is really just that regardless of whether an internal transaction is considered or whether there's a potential for an external sale of the firm, everybody needs to be on the same board, on board and on the same have the same mentality about, what the next steps are. So when you take all these together and you look at the valuations we're seeing today, most acquirers are viewing firms based on a discounted cash flow basis. So they're basically looking at the cash flow of the firm and discounting it back to present value, as many of you would that are portfolio managers or analysts on the call. If you're valuing public companies, it's really not that much different the way that buyers are looking at wealth management firms today. Discount rates that we're seeing are typically 18 to 20%, have been the last few years in what buyers are really expecting in terms of doing these deals and a return on their capital, which is low in general, because private equity groups across the board, if you look at all the different industries out there, are typically 25% plus in terms of their discount rates that they're looking at. In the wealth management industry, because of their recurring revenue, the certainty of the client base and other things, there's just this requirement of a lower discount rate. And so, of course, when you have a lower discount rate, it means a higher current valuation, which is, again, why a lot of these firms are valued the way that they are and have been over the last few years. And ultimately, though, what you end up seeing generally, and then these are very large ranges, but around 2 times to maybe as high as 4 times revenue, 7 to 10 times EBITDA are ultimately the equivalent at the end of the day, depending on the firm and margins and everything else. But that's just kind of how all these deals have been coming together over the last few years. There are a couple of other things here related to valuation. Again, we talked about the discount rates required by buyers today, which is a big driver of valuations. Ultimately, the biggest thing to remember in all this is that value is in the eye of the buyer, and who you're talking to is going to value a firm very differently from one person you talk to another. And they're going to look at different aspects of the firm, look at synergies differently, look at geographic regions, client bases. There's so many factors that are drivers of valuation, but at the end of the day, value is really what it's worth to certain people that you talk to. Not going to spend a lot of time here on this slide because this is really a lot of the things we talked about with regard to why wealth managers or asset managers are worth more or less in relation to each other. We've covered a lot of this. This one, though, we've got a couple of minutes left. I would like to try to keep the call, right to an hour on time if we can, so we can get everybody out and back to work and taking care of your clients. But this slide is one that we put together. Hope everybody can see this okay. This was after getting just continued questions from partners in firms, second generation in firms, about why would I consider an internal succession versus an external sale of the business or any other external capital raise. And so this is just sort of a roadmap for determining what makes sense and how this all works out. So if you start in the top left, the first question any current partner or founder has to ask is there a second generation staff who's already in place? If the answer to that is no, then you really don't have a lot of options. It's pretty much an external sale or merging with another firm. If the answer is yes, you have to ask whether that second generation can manage the business, manage the relationships, and grow. Because all those things are required. A lot of founders wore 3 hats: management, managing relationships or managing portfolios, and growing the firm. And so second generation has to be able to do the same thing. So then if the answer to that is no, well, can those roles be split between 3 second gen? So can you have, one person who really is good at business development, one who's great at managing clients, and one who, can be a great COO? You can still accomplish an internal transaction. So either way, whether they can manage the business or whether, there are multiple second generation partners who combined can do or at least replace the role of the current partners or founding members. Then the next question is, do they have the ability to borrow funds to purchase the business? Because you have a couple of issues here. And number one is, even with the amount of lending and capital available, second generation partners are often asked to provide collateral, or the founding partners are asked to co-sign those loans and essentially provide personal guarantees. And so if owners are not willing to take that risk internally, then sometimes external financing is not possible, and so then you have to ask the question of whether the owner is just going to finance the sale altogether, And if so, in order to make that work, what we really see for the numbers to work often is that the second generation partners may have to take a pay cut in order to make the loan numbers really work out, and in order to make the payments to the retiring or exiting partner. And so there's a lot of dynamics that take place internally that people don't always think about for an internal succession to really be successful. And also there's really this dynamic that we see quite frequently, where founders sort of assume that second generation is going to buy them out. And the second generation may tend to sort of assume that the founding partners or first generation are going to owner finance that for them. And that's not always the case. And so internal successions require communication, they require planning, and require things to be really well thought out and done the right way in order to make it work for both sides. At the end of the day, the thing that I always tell people is that an internal transaction or an internal succession is still very much a transaction. You know, a lot of people make the mistake of thinking of an internal succession in a different way, but at the end of the day, in an internal succession, you have a seller of ownership or shares, and you have a buyer of ownership and shares. The buyer is going to want to get that ownership at the lowest price possible. The seller is going to want to be compensated for the firm that they've built and what they have done to get the business where it is today. And so it requires being on the same page as far as what the value of the firm is worth and how that value is going to transition. So, you know, understanding value and communicating are extremely important aspects of transitioning a wealth or asset management firm. And this is really, there's some other slides here that we've talked about in terms that we can talk about in terms of challenges you face on an internal or external transaction. If anybody's, you know, considering either path, I'm happy to talk in more detail, answer any questions I can about either, but we can end it here just for timing purposes. Again, thank you all for joining us. Appreciate you taking some time away from your day to join us today, and I'm happy to answer follow-up questions through emails or phone calls. I think John and Ralph probably both know how to get in touch with me. So again, appreciate it, and please let me know if there are questions.
And I had sent something out via the chat, which I thought would be one way that panelists or non-panelists could pose a question. If you'd like to do that, please do. John, one thought I had was that something that has changed drastically over the 20 years or so that I've been around is that if you worked with a family, you know, husband and wife, you just assumed that you would work with the kids as long as you didn't screw it up. And with everyone moving like they do, that is much more a rarity. And so I see it's interesting that they're looking at the longevity of people with the individual lives as you're looking at clients. But there was a time where you looked at working with kids and it behaving more like an annuity that you would keep the funds. Have you seen that? Have you seen changes along those lines, or how does it get worked in if you're working with a family, what odds that you have of keeping the funds?
Yeah, I mean, we typically see two sort of schools of thought here from the people that we work with. And one is that, you know, their thought is that while some of the second generation today may not have the money to invest and may be looking at, you know, some of the cheaper, low cost alternatives, that their parents aren't currently using, they feel like once those people do get to a certain level of wealth, that they're still going to need an advisor and that they can be that advisor for them because they've helped the family. Then you have this other school of thought where people just are thinking that this next generations just are approaching wealth and asset management in a totally different way, and they need to take more drastic measures to retain the generation of clients that are coming along today and inheriting wealth. And so I think you've got two dynamics there. One is exactly what you mentioned, which is just people moving around, not really staying in the same place like they once did. But then you also have the question of whether there are changing preferences of younger generations and how they access wealth management and asset management products or advice. And so that's where, particularly with succession planning, can be really important to have the right second generation players in place who can communicate with their peers and be there to, whether it's a changing preference or moving geographies, you have two people of the same generation that are working together and sort of understand each other and what they're looking for. So it's a good point about just the succession in general and importance of having a second generation.
And I'm not seeing anything via the chat. Another, John?
Yeah.
Oh, I was reaching out to John Lola. I thought John said something. I will throw this out too. For your business, what percentage is buyer driven? What percentage is seller driven?
You mean for the clients that we work with?
Correct.
So we are about 70% of the time representing sellers and 30% of the time representing acquirers.
Okay. I want to be mindful of everyone's time as well. John, this has been refreshingly different. It's something that I don't think gets thought of a lot until it hits some people in the face. And I think it reflects too the changing industry. And so it's a way of having sort of your finger on the pulse of things. So thank you for bringing this and wish you well. We are opening this up. We'll be sending out an email and hopefully getting some feedback. And if we do, we'll pass that along to you. But any other closing comments?
No, again, just appreciate everybody's time. Thank you for being here today. Always happy to answer questions if you have them regarding these issues. And Ralph, I think you're right. It's a great way looking at activity like this in any industry, whether it's wealth management or elsewhere, is a good way to sort of keep a finger on the pulse of what's happening and where the industry's headed.
Right. Well, folks, thank you again. Be looking for the email and be looking for future emails with meetings. We meet together as a group and just being able to get out of the house. So please send any thoughts or comments that you have to us. We're looking for the feedback. And John, thank you again. I thought that was an excellent talk. And
thank you. I appreciate it.
Just an aside, am I remembering correctly? Is the name of that river the Ocmulgee? Am I pronouncing that anywhere close to correctly?
Yeah, that's about right. It's
okay.
Not too far from here, actually. Yeah.
Some old, Creek Indian name or something, or I have no idea, but okay.
Yeah, it's there's the Ocmulgee Indian mounds are here.
I didn't realize there were mounds.
Yeah.
Okay.
So I think it's actually one of the largest sites in the country. It's pretty big.
I'd never heard that. Well, Macon's a beautiful town. Gets a little hot in the summertime, a little muggy.
Yeah, that's for sure.
Okay. Well, John, thank you again. You. And John Lowley, if you're on here, thank you for setting this up and allowing everything to run so smoothly. So stay healthy. Have a wonderful day. Goodbye, everyone.
Thank you.
Goodbye.